What is Jitta Line? Jitta Line represents the fair value of a company based on its business performance over the past 10 years. The methodology is inspired by Warren Buffett's stock valuation concept, which determines a company's value according to its ability to generate returns for its investors going forward. The model is similar to discounted cash flow, except Jitta Line takes into account a wider range of financial factors beyond just cash flows. And like Jitta Score, it excludes extraordinary items such as one-time sales of assets to truly represent a company's potential. In simple terms, Jitta Line suggests the fair price you should pay for a business to break even in 10 years. Suppose a company consistently earns $1 million in profit per year. Jitta Line will suggest a fair price of around $10 million, which should take 10 years for the business to earn back for you. This relatively conservative valuation gives you a realistic view of a business and helps reduce investment risks by creating a margin of safety. The greater margin of safety you have, the lower the risk of losing money and the higher the possibility for making a profit. It's like going shopping. You don't want to overpay for an item. You either pay what the price tag says or less, never more. This ensures that when you resell, you don't lose money on the item. That's the margin of safety. In the context of stocks, Jitta Line is the price tag. Your margin of safety is determined by the price you pay. If you pay more than the fair value, assuming that the stock will appreciate in price, you run the risk of losing money if it doesn't. This type of risk arises when there is not a sufficient margin of safety. On the contrary, buying a stock at a discounted price or below its fair value provides a margin of safety. This cushion makes sure that you won't lose money, even if the stock's price remains the same and never appreciates. You may even make a profit from it. Another thing to consider is business quality. Lower quality businesses require a larger margin of safety than higher quality ones because they pose greater risks. But even for high quality businesses, you still need a margin of safety. Great companies can become bad investments if purchased at too high a price. And that's Jitta Line, a simplified indicator of business's fair value developed by Jitta to help value investors like you quickly decide how much to pay and when to buy so you can invest with more confidence. Check out Jitta Line of over 36,000 stocks in major exchanges around the world, including China, Japan, and the US, free on the Jitta app and jitta.com.